Welcome. Raising business finance. Whether it's a loan from your bank, an investment from a private investor, or capital from a venture fund, is one of the most consequential things a business owner will ever do. It's also one of the most demanding. And the difference between success and a stalled deal often comes down to one thing: the quality of the financial leadership in the room. In this video, we'll look at how a fractional CFO transforms your chances of raising finance on good terms. I'm from the advisory team at Quantum House Australia, accountants and tax advisors. Here's our plan for the next quarter of an hour. We'll start with why raising finance is so demanding. Then define what a fractional CFO actually is. We'll cover exactly what lenders and investors want to see, the financial model at the center of it, and how to prepare for due diligence. Then the banking relationship and negotiating the terms, a worked example. The real difference it makes, the common pitfalls, the key takeaways, and how we can help. Let's start with why this matters so much. Raising finance is genuinely high stakes. The outcome can shape the next decade of your business. But here's what catches owners out. It's also intensely demanding. Banks, private lenders, and equity investors will scrutinize your financial model, your historical performance, your management capability, and your growth projections with a level of rigor that most SME owners simply aren't prepared for. They do this every day. For you, it might be once a decade. That asymmetry is the real problem. The good news is that it's a solvable one, and the solution is bringing in the kind of financial leadership that speaks the lender's language fluently. That's exactly what a fractional CFO provides. And it's worth saying clearly, lenders and investors aren't trying to catch you out. They're trying to get comfortable. Your job, with the right help, is simply to make that easy for them. So first, what actually is a fractional CFO? In simple terms, it's senior, part-time finance leadership, the capability of a chief financial officer without the full-time salary a CFO commands. Most growing SMEs can't justify a full-time CFO and don't need one every day of the week. But there are moments, a capital raise, a major bank application, a growth inflection point, where that level of financial firepower makes all the difference. A fractional CFO, sometimes called an outsourced CFO, is brought in for exactly those moments. They bring the financial modeling, the investor-ready documentation, and the hard-won negotiating experience that a business rarely has sitting in-house. The same senior expertise, scaled to what you actually need. Engaging one is often the difference between a raise that drifts for months and a raise that actually gets done. So what are these lenders and investors actually looking for? Underneath it all, they're answering one fundamental question. Will this business generate enough cash flow to service the debt or to justify the investment? To answer that with confidence, they expect a specific set of things. Detailed financial statements, ideally audited or reviewed. A 3-year financial model with clearly articulated assumptions so they can see the logic, not just the numbers. A cash flow forecast. A clear explanation of your competitive position and growth strategy. And, for an equity raise specifically, a clear articulation of how you'll use the proceeds and the return investors can expect. Here's the rub. Most SME owners simply don't have the financial modeling skills to prepare these to institutional standards without support. And to an investor, a weak model doesn't just look weak, it makes the whole business look risky. Think of it less as a pile of paperwork and more as the evidence base for a single claim, that the money is safe in your hands and will be put to good use. Let's talk about that model because it's the centerpiece of any funding conversation, and it's not a simple spreadsheet. A proper model integrates your income statement, your balance sheet, and your cash flow statement, all working together. Change one assumption, and the whole thing updates coherently. Each line is built up from granular assumptions. What actually drives your revenue, your cost structures, your capital expenditure, your working capital. And it has to be dynamic. When an investor asks, what happens if your biggest customer leaves? You need to run that scenario live, in the meeting, not promise to email it next week. Crucially, it must reconcile to your historical actuals, or it loses all credibility. A A fractional CFO builds and maintains these models to institutional standards, so they're both technically correct and genuinely persuasive. The best models also tell a story. They don't just prove the business survives, they show how the funding accelerates it.
Suppose your model lands and the lender or investor is interested. Now comes due diligence, a comprehensive review of your financial records, your contracts, your tax position, your legal structure, and your key person risk. And here's something owners underestimate. Due diligence moves fast, and deals are genuinely lost simply because a business can't produce the documents quickly enough. Momentum matters in a deal, and nothing kills it like a founder scrambling for a contract that should have been to hand. The answer is a data room, an organized, well-maintained repository of all your key financial and corporate documents. A fractional CFO keeps that data room ready, so that when due diligence begins, you respond promptly and professionally, and the deal keeps its momentum.
Two more pieces, and they often decide the quality of the outcome. The first is the banking relationship. For bank finance, the quality of that relationship significantly affects both your access to credit and the terms you're offered. A fractional CFO manages it proactively, giving the bank regular management reporting, flagging issues before they breach a covenant, and engaging in the language credit analysts actually respond to. Banks lend with confidence to businesses they understand. The second piece is negotiating the terms. Interest rates, fees, covenants, security requirements, drawdown conditions. These are all negotiable, even when the bank presents them as fixed. But negotiating well requires knowing the market norms, understanding your financial position relative to the lender's criteria, and spotting your leverage points. A fractional CFO, who has been through many of these transactions, negotiates with a sophistication the typical owner simply hasn't had the chance to develop. And it's worth remembering that the relationship outlasts the deal. The way you handle this raise shapes how the bank treats you at the next one.
Let me make this concrete. Picture Vela Logistics, a fictional freight and warehousing business that needed around $2 million to fund a depot expansion. The founder approached his bank directly, and the conversation stalled. The numbers were all there in zero, but there was no integrated 3-year model, no clear explanation of how the loan would be serviced, and the projections didn't reconcile to the historical accounts. To a credit analyst, it simply looked risky, not because the business was risky, but because it was hard to follow. So a fractional CFO stepped in. They built an integrated 3-statement model with clearly stated assumptions that tied straight back to the actual results. They prepared a concise data room, so every document the bank asked for was ready within hours. And they represented the request in the language credit analysts respond to: debt serviceability, covenant headroom, downside scenarios. It was the same business, with the same fundamentals, but now it was legible. The facility was approved, and on a sharper interest rate, with one less restrictive covenant than the bank had first proposed. Nothing about Vela had changed, except how clearly its story was told. And in a funding conversation, that clarity is worth real money. Illustrative, of course, but it's exactly how these things play out. It's a pattern we see constantly. Strong businesses quietly underselling themselves, simply because no one had translated the numbers into the lender's terms.
It's worth pausing on that, because it's the heart of the matter. Going it alone tends to look like this. Your numbers in raw form, a static spreadsheet, slow responses to document requests, and terms accepted more or less as offered. Deals stall, or they land squarely on the lender's terms. CFO-led looks different. An institutional-grade model, a data room ready to go, fluent conversations with the credit team, and terms that are actively negotiated. You raise with confidence, and usually on better terms. And remember, it's the same business in both pictures. The fundamentals haven't changed. The only difference is the quality of the financial leadership in the room, and lenders can feel that difference immediately. Put simply, good financial leadership doesn't just improve your odds of a yes, it improves the terms of that yes.
A few pitfalls to avoid because they're common and they're costly. The first is approaching lenders unprepared. A first impression with a credit analyst is very hard to undo, so get ready before you knock on the door. The second is a weak or unreconciled model. If it doesn't tie to your actuals or it can't flex to answer a question, it quietly erodes confidence. The third is having no data room, so document requests drag and the deal loses its momentum. And the fourth is treating the terms as fixed, accepting the first offer when rates, fees and covenants were all negotiable, and leaving real money on the table. Every one of these is avoidable with the right preparation and the right person leading the process.
Let's pull it together. Raising finance is high stakes and it's judged with institutional rigor.
A fractional CFO gives you senior finance leadership, part-time, for exactly those moments. Lenders want a reconciled 3-year model and a clear cash flow story. A ready data room keeps a deal's momentum on your side. Manage your bank proactively and in their language. And remember, the terms are negotiable and well worth negotiating. Get those right, and you walk into the room not hoping for a yes, but expecting one, on terms that work for you. And none of this is about spin or dressing things up. It's about presenting a genuine business accurately, completely, and in the form decision makers expect to see.
This is where Quantum House Australia comes in. Our outsourced CFO service has supported numerous Sydney businesses through bank finance applications, private equity processes, and capital raises. In practice, that means we build the financial models and prepare the management accounts to institutional standard. We manage the data room and the due diligence process so you can respond fast. And we advise on the deal terms, negotiating from a position of strength. And because finance deals always carry legal and tax dimensions, due diligence, security documents, tax structuring, warranties, we draw on our colleagues at Australian tax experts, tax advisors and lawyers, so the accounting, the tax, and the legal advice all sit together in one place.
So here's the thought to leave you with. If you're planning a raise or about to approach your bank, don't walk in hope, walk in prepared. The businesses that secure finance on the best terms aren't always the strongest on paper. They're the ones whose story is told clearly, by someone who's done it before. Quantum House Australia gives you that financial leadership. Visit quantumhouse.com.au or call our Sydney office on 1-300-809-697. Thanks for watching. Quantum House Australia, accountants and tax advisors, setting a new standard.